Hi, everyone. So I wanted to discuss quickly the outlook for the steel product market for the end of this year and the beginning of the next year. We'll start, as always, with the GDP growth projections. So in the words of Isabel Schnabel, member of the Executive Board of European Central Bank, we have entered a new period in the world economy, the Great Volatility period. The Great Moderation period was a period of prosperity and stability. The Great Volatility will bring us instability, inflation, and slow growth. Looking at GDP projections, the IMF made in July 2021, April 2022, and July 2022, we can see that they keep reducing growth projects. A year ago, in 2021, they expected the world economy to grow this year by 4.9%. In April 2022, only 6 months ago, by 3.6%, and now by only 3.2%. In 2023, the world economy is expected to grow even slower, by about 2.9%. The main factors affecting the slowing down in the world economy are the effects of pandemic and the war in Ukraine, increasing food, energy, and commodities prices. Slowing down will affect both advanced and developing economies. If we have a look at growth projections per country, as you could expect, European Union continued to be affected the most, as it suffered the most from the war in Ukraine. GDP in the EU is expected to slow down from 5.4% in 2021 to 2.6% this year and only 1.3% in 2023. European countries are introducing various programs reducing energy impact on the consumers in order to help the economies. In effect, this is moving the burden of the energy shock from consumers to the governments. Theoretically, it should slow down this energy shock on the economy, so the above projections may be a little bit over pessimistic. In the USA, the IMF also expects the growth to slow down from 5.7% in 2021 to 2.3% this year and only 1% in 2023. But the USA is self-sufficient in energy. I don't think this is taken into consideration. USA has not been affected as much by the war in Ukraine. So at the end, they may come out much better from all this than the European Union, for example. Now, China. Chinese GDP is expected to slow down this year from 8.1 to 3.3%. The country is at the crossroads. Their model of rapid export growth is reaching its end. Chinese government has some difficult decisions to make this year. Much better performance in the economy we will see in the Southeast Asian countries. They expect to grow by about 5.3% this year. Middle East at 4.8% and Africa at a respectable 3.8%. And actually the best performance in the world is expected from India, a growth of about 7.5%. The main, of course, topic of discussion, the main factor in the world economy is the inflation. War in Ukraine aggravated already high commodity prices. Inflation is approaching 8.7% worldwide, up from 4% in 2021. In the USA, inflation reached 8%, but recently the trend started reversing. In the USA, the reason for inflation was mainly monetary, and there are monetary instruments that the Fed can use to reverse the inflation trend. In Europe, inflation was caused by energy and food prices. Once these extra costs become entrenched in the economy, once they are passed to all basically levels and to all producers, there are no easy economical instruments that can help getting rid of them. The danger of inflation for the steel industry, for all of us, is that the real wages are falling and they reduce the aggregate demand for consumer products, thus reducing demand for steel. In the developing countries in 2023, the inflation is expected to be around 10.3%. Main inflation drivers. As you can see from another IMF chart, the main drivers of the inflation in 2022 were food and energy. Since the start of last year, the average contribution just from food exceeded the overall inflation rate during 2016-2020. It's crazy. Yeah? So in 1 year, we've got more inflation than in 4 previous years. A similar story holds for energy costs, which also show both directly and indirectly through transportation costs. And so far, there are no signs of inflation slowing down in the world. Looking at the construction sector overview, it's very difficult to get the world picture, so we only have European really picture in construction. Despite all the challenges that the war brought to Europe, construction sector have recuperated very, very quickly after COVID. Already in 2021, last year, we have returned to pre-COVID levels, and this year we're going to be growing in construction at over 15% higher than the base rate in 2015, 2016. There are plenty of projects, private, government, and all kinds, and the situation is pretty good actually in construction. Moving to the world steel production. It's a little bit cramped, but unfortunately, this year, the world steel production is expected to decrease by about 7.2%, approximately 140 million tons. Production will decrease worldwide. Only in the Middle East, overall, production will increase because Iran will increase production by about 8% to 30 million tons. In January, August 2022, the European Union has decreased steel production by about 7%, Northern America by 3.6%, Asian countries by 4.3%. The main steel from the main steel producing countries, only India will produce more in 2022, about 7% more, which will take them to about 120 million ton this year. China will decrease its production by approximately 5.7% in 22, about 60 million ton reduction. That's a world, or the picture of the world, how production will be reducing everywhere. Looking at the Chinese steel exports, we haven't seen any substantial increases so far this year. At least until end of summer, exports have been at the levels of 2021. Recently, there have been some rumors and signs of increases in the long steel exports, but this has to be monitored if it will really take place. So far, the government managed to not to kind of allow mills to export, but we will see if this remains. Now let's go to the long products consumption. Estimates of the long products consumption, which were available until the end of July, show the consumption of steel products decreasing about 5.5% in 2022. It's actually an improvement because at our last conference, we estimated the consumption to decrease about 9-10% this year. In total, we will lose about 54 million ton consumption of long products. If we look at the per product consumption, you can see that we're going to lose consumption in basically in all the products, but the main, we're going to lose about, in wire rods, we're going to reduce about 9.4% consumption by 22 million tons, in rebars, 6.5% by about 28 million tons, merchants bar only 0.5%, sections about 7%. So it's mainly rebar and wire rod we're going to lose. Moving on to the rebars consumption. If we have a look at the rebar consumption per regions, in 2021, we have seen a fantastic growth in rebar consumptions to the level highest in history of 426 million tons. This year, the rebar consumption is expected to decrease by about 28 million tons. And the mainly consumption will be lost in Asia, in China. This helps visualizing how the share of Asia in China is reducing in the world consumption. This year, we're going to see the reduction of the Asian consumption from 64% in 2021 to about 59% in 2022. And Chinese rebar consumption will reduce from about 61% in 2021 to 55% this year. If we have a look at the long trend in the rebar consumption in the last 10 years, you can see that the consumption was growing mostly in Northern America by about 32%. It's true that 2011 was probably the worst year in American history in consumption, nevertheless. Also, rebar consumption increased substantially in Southeast Asia and Northern East Asia, and also in the CIS and Eastern Europe. Now, moving on to the most interesting topic, the price movements. So we've had a turbulent year so far. Since our last conference in May, the markets have been adjusting to the new realities. Exports from Russia of the finished long products have reduced substantially. There is a strong domestic market supported by the government. Also, the local currency is very strong, which discourages export. These export volumes of approximately 10 million tons were mainly of wire rods. 5.6 million tons Russia has reduced exports, 2.2 million tons each Ukraine and Belarus. All these volumes, they have been replaced mainly by South Asian mills, and also recently by the exports from the Middle Eastern mills. Of course, Russia is still looking everywhere for new markets, and they are pushing, but it's not that easy for them. It seems to be that the new two-tier market has formed. Sanctioned countries and the long voyage origin material, and then local mills and short voyage origins. Sanctioned countries sell at very low prices to mitigate the risk for buyers. Then the long voyage origins also have to sell at very low prices to compete because of the market volatility. The longer the voyage, the greater risk of the price decreases, and thus customers only want to buy from far away only if the premium is very high. So they only prepare to buy if the price is very low. So we are facing kind of contradictory trends in the market. On the one hand, lower demand for finished products, and on the other hand, rising cost of production. It will only lead to the greater volatility in the prices. If we look at the spread evolution, steel mills find themselves in a situation when they have to reduce sales because of the weaker demand and cheap offers from sanctioned countries and long voyage origins. But the mill's costs are actually higher, much higher, because of the energy price hikes and also because of unpredictability of the energy prices. In many countries, steel mills don't know day to day what price they would be paying for the input materials, especially for electricity. They have to price in this unpredictability, and because of this, steel mills prefer reducing output and keeping margins at the levels that would protect them in case of unexpected input material hikes. The result, mills are concentrating on their core markets and lower volumes and margins sufficient to cover the risks. From a mill point of view, there is no point in reducing price in order to sell more tons. These marginal tons at reduced price have already been taken out by the market by sanctioned countries. Reducing price for the mill would just lead to reducing price on the whole order book. Also, it means that those additional tons would mean buying additional expensive scrap and paying this extra price for additional electricity, thus increasing the cost further. If we look at the demand outlook, after the pandemic, demand for steel products went up. Supply was restricted, war in Ukraine caused shortages. Customers stocked up and steel prices went up. During summer 2022, supply bottlenecks started easing out. One of the best indicators of this is the container freight. According to the Drewry Index, composite container price index went down from $10,500 to $4,000. Also, customers found new suppliers replacing CIS tonnages. The market has adjusted and the prices for steel products went down to the pre-war levels. Now, rising inflation started eating into the real income. 10% world inflation means 10% less money to be spent on a new fridge, on the house renovations, etc. People delay purchasing decisions. Developers cancel their next project for the commercial center. All these factors are contributing to the downward pressure on the market. On the other hand, mill production costs went up substantially. Rising cost of energy. You can see in the next slide that the gas prices, even though they've gone down from the top at the end of August, they continue to be at the highest levels in history. Electricity prices in Europe, they reached 1,100 euros per megawatt an hour in August, at the end of August, beginning of September. What we should be watching out, in our opinion, is that recently energy crisis started spilling over outside of Europe to the developing nations. Any country that is importing energy is at risk. For example, recent auctions to buy LNG in Pakistan and Sri Lanka have not attracted a single offer. Situation is similar in India, Bangladesh, Southeast Asia. European buyers are buying all LNG available. Developing countries cannot afford to pay the price. At some point, developing countries will have to start passing these extra costs to the consumers. Then it will become interesting. How will all the steel mills in the developing countries will be able to process these extra costs? Contagion is also spilling over in other forms of energy. When the utilities rushed to buy thermal coal to replace gas, the prices of coal went into all-time high as well. Newcastle Coal Index hit a record $437.5 per ton. With Russian gas supply in the Baltic Sea permanently taken out of the world energy equation, the world energy market will have to readjust to the high levels. These new high energy prices will arrive eventually to all the countries that import energy, and they will stay with us for some years to come. That means that the cost of production for steel mills will also be at the high historical levels, and this cost will arrive eventually everywhere. Slow motion financial crisis in China. Situation in China remains complicated. What is happening? We will have a special presentation in China. Just also give a little bit of my input. What it can be called as a slow motion financial crisis. On the one hand, China's manufacturing steel demand rebounded in August and September, as you see in the orange line. It's actually at the best level since 2018. But this for the industrial goods, production of industrial goods. On the other hand, property market continues deteriorating. As you can see from the next slide, from the Financial Times, the Chinese new construction starts have fallen more than 40% every month since April this year. And they started falling in the second half of the 2021. According to the World Cement Association, in 6 months this year, Chinese companies produced 15% less cement than previous year. Of course, the government is trying to counter it. There are various stimulus plans for the infrastructure. Recently, for example, Shanghai announced $270 billion program for the new infrastructure. But so far, this infrastructure spending were not able to offset the drop in private construction. This slow motion financial crisis, as experts tell us, is slowly moving towards the bond market. Local governments in China have more than $7.8 trillion in bonds. As properties are not sold and new projects are not started, there are no sales of land, and it's not clear how these bonds would be financed. To sum up, there are divergent forces pushing at the steel market. On the one hand, inflation is reducing real income. Customers expect a recession and are convinced that the end of the world is near. They keep their purchases at minimum, stocks at very low levels. On the supply side, so far, there were suppliers who were able to produce steel cheaply and fulfill the gap left by CIS producers. But these were short-term opportunities. New energy prices will arrive eventually everywhere, and the high costs will arrive to all the countries which import the energy. So we have these opposite trends that will pull the market in different directions. They will apply to raw materials, to energy, to upstream and downstream production. Government keep intervening, and this will more complicate the situation. So, guys, brace yourself. Winter is coming.
Are there any questions from the floor for Alex? Can we have the microphone?
Good morning. Always a perfect presentation. One thing I noticed that you have shown that the construction, actually the world production is going down, and I noticed that the majority of what's coming down is from China. Now, we understand the effects, what's going on in in Europe or in even in Turkey because of the energy cost that's going up. In China, they have cheaper energy coming from Russia. They, and they have huge subsidy, just like you mentioned, $250 billion into construction. So why do you think that they are reducing the production? Why do you think that the consumption is going down in China?
I can say that why consumption is going down, but it's very hard to understand what exactly is happening. I was actually hoping that the next presentation today will kind of shed a bit of light on it. The consumption in China is going down because the way it was financed is not working anymore. So how they finance in China? People buy flats before they even the project is approved. They get the mortgage and they start paying mortgage before the foundation has been dug out. What's happened recently is that you remember the scandal with Evergrande. They started going bust, these companies. Why? It's a long story. I don't know exactly, but they started going bust. Because they started going bust, people refused to pay. There is such thing in China as a mortgage boycott. People refuse to pay the mortgages on the flats they bought, which have not been even started building, but people have to pay. They stopped paying, and that creates kind of like a wave effect. So construction companies, their old financing way is not working anymore. So they can't build more. People refuse to buy properties at the time of before the project is built. And so the finance scheme of the construction industry is broken in China. How are they going to fix it? I really do not know.
What makes it more interesting is now you're saying it's going to be below what it was during the pandemic years in China, which came almost a year after when Europe and the rest of the world really faced. So it's dramatic decrease.
It's a dramatic decrease. Chinese government always managed to sort things out by investing in the infrastructure. But recently, it's not working very well because they keep investing and investing and investing in more infrastructure. But I have no idea, like, what they're going to do. Build another airport in Shanghai. Build 3 more airports in Shanghai. I mean, they need to fix the financing scheme. And I think that they're kind of facing, the political system in China is facing the economic reality finally. But it's very, very slow. Like we're used to very, very quick crisis. In China, it's a very, very slow crisis, but it's spreading around. It's going to be complicated.
Thank you very much. We have another question over there.
Good morning.
Good morning.
On price of electricity, which you have today as a producer, compared to what it was before the crisis, what would you say the kind of percentage of costing on a ton, per ton?
It depends when. Yesterday, today, or tomorrow.
Well, that's it. That's it. Budget-wise, you're looking at production cost. What would you do today?
It's impossible. This is the problem, that you do not know what price of electricity you have to pay today, tomorrow, or in 1 month. At the moment, prices have gone off the peak, which they were at in the beginning of September. Why? No one can explain. It's kind of effect of the government intervention. So the governments in different European countries are introducing these energy capping mechanisms, which basically effectively they say, okay, the consumers will not pay above this level. Everything above will be paid by the government. At the end, the bill will arrive. How it's going to be paid, no one knows. No one understands it.
But we don't know. We don't know what the future is, but we know what the past was and the present is. So, if you were to look at, for instance, 6 months ago, what would you have calculated per ton for electricity?
I understand the question.
Calculate on today's price.
So I would say, I would give an estimation, and it's very roughly, and it's different for different mills in different countries because the distribution of energy burden is very uneven. in time and in countries, because in different European countries, you have different price of electricity. In Turkey, sometimes they now pay higher price than in some European countries as well, as we discovered recently. So I would say if before the cost per ton was, let's say, 10% of energy per ton of produced rebar, that maybe now it arrives to maybe 50 or even 60%. Would that be right, guys? Would you agree with that estimation? 60, maybe even I would say 65% sometimes.
Thank you very much. Do we have Phil?
Yeah, I'd just like to follow up that last question. So, as you said, Alex, energy costs, or electricity costs rather, are very different in different European countries and indeed outside of Europe. So, CELSA has production in multiple European countries. You produce in the UK, you produce in Spain. Last time I looked, the cost of electricity in Spain was 1/3 of the cost of electricity in the UK, and less than half of the cost of electricity in Germany, for example. How much do you see this going to distort trade patterns within Europe? Number one. And number two, do you think there is a case, which of course is not in the interest of the European mills necessarily, like CELSA, there's a case for easing import of rebar into Europe from countries where they do not have a shortage of power, which is a way of effectively importing energy into the EU?
It is true that the trade patterns in Europe are distorted because of the energy prices. On the other hand, the governments of the countries that have been mostly affected by this, so let's say Germany, UK, they were the ones who were first to introduce the capping mechanisms. So the mechanisms that put like a maximum price that consumers would be paying for the energy. So that has been rectified already to some extent. Now, regarding the easing of the import, according to our numbers, this year the import into European Union of lawn products have increased by 25%. And we believe that there are mechanisms in place which allow for the steel produced outside the European Union to enter the European Union in quantities enough to maintain the healthy demand and supply. What we don't agree with is that, for example, in European Union, we are eventually, basically, the reason the European Union was the first to be affected by the energy price increases was the green policy that European Union implemented. So effectively, we are, as citizens of the European Union, are paying the price of the green policies. If we now allow the free import of goods outside of the European Union, what was the point of that Green Deal in the first place? So if we are prepared to have a Green Deal, if we're prepared to clean our act and to reduce our energy output, that has a cost. And that cost has to be spread amongst everyone. If we now start bringing dirty steel, you bring dirty steel from Asia, from blast furnace, it has a CO2 content 10 times more than the steel produced in the European Union. So that's a political decision that has to be made. But we believe that there are mechanisms in place now, as we can see from the import statistics, that allow free flow of the goods.
Thank you very much, Alex. I believe no more questions.